Hi, I'm Dave McNab, President of FlowTracker Analytics. Today I'm going to introduce you to a new framework for measuring sales, attrition, and cross sales based on looking at customer behavior. We'll start with looking at the theory. Why do you need a new framework? Why do you need it now? What is the framework? And then we'll give you some practical insights into how to use it and how to implement it. So why do we need a new framework? Why now? 1/3 of sales and marketing efforts contribute nothing to growth. The reason for this is because banking systems don't separate product substitution from new and lost money. Here's a simple way of looking at banking. As a bathtub full of water representing the deposit and loan balances in the portfolio, sales, bringing new money into the bank, will increase the water level. Attrition, draining out the bottom of the tub, will lower the level of deposits and loans. But in addition to that, there's two other flows that are really important. One is the normal variability caused by customers using their banking products. And the other one is product substitution, which largely goes unmeasured in banking analysis. Let's start by taking a look at the classic measurements that most banks already have. Pretty much everybody's able to measure new customers and lost customers and see that as acquisition and attrition, which it truly is. Then we get into the cross-sale area, where we have product acquisition and account acquisition within ongoing customer relationships. And finally, there's the component that is the organic growth or diminishment of bank accounts. The problem with those traditional metrics, all of which measure new money and lost money to some extent, is that they combine those external cash flows with product substitution and account substitution that is happening inside the bank. On the lending side of the bank, the difference between measuring cash flows and measuring account growth, new accounts, new products, and new customers is not that severe. But when we turn to the deposit side of the business, the impacts of product substitution and account substitution are significant, inflating performance metrics and analyses by 15 to 25% and even more. So your performance metrics are inflated. Why should you care? Well, the problem is you're paying 15% too much for sales compensation if it's based on account level growth or product growth. You're targeting the wrong clients up to 30% of the time on both the sales and attrition side. Spending too much on marketing programs, targeting the wrong clients. Can't react to or predict changes in customer behavior because you don't understand product substitution. And it's absolutely impossible to optimize pricing without being able to measure true sales, attrition, and cross-elasticity of demand. And this impacts customers, employees, and shareholders. There are about 15 use cases, business decision-making situations, where being able to measure the flow of funds is really valuable. Here's the top 5. The first is being able to detect customer behavior changes. That's changes in term preference, changes in liquidity, changes in risk preference, that kind of thing. Enabling prediction of those customer behaviors, because measuring is the start of all prediction. Being able to understand the effectiveness of marketing campaigns, managing sales force compensation, goals and targets, and being able to accurately measure return on marketing investment. So let's look at how to do it wrong. Well, Wells Fargo is a classic case. It's been in the paper a lot lately. Got 185 million in fines. They're subject to congressional hearings, and even the CEO resigned. The problem is they're measuring the wrong thing. Their focus on cross sales was simply counting the instances of products that customers have and trying to drive that number up. Doesn't necessarily bring a single dollar into the bank. Another global bank, this one in Canada, tried to measure the cash flows going through customer accounts and the customer behavior by actually mapping the transactions from one system to the next. This is a very complex undertaking that took them over a year in analysis and design, cost them a couple of $1 million, and still doesn't work because what actually happens is all the transactions go through the checking account, and on their way to their end destination. And as a consequence of that, you can't actually resolve the many-to-many relationships that occur in customer behavior. So they have a right idea. Problem is they're measuring the thing wrong. The third approach we've seen big banks try is to build a model themselves. So they get their data scientists to work on building an analytic model that'll give them the answers that they want, enable them to see the customer behavior they're looking for. This is typically in response to a specific management ask. We've never seen a bank build one that was an application that was scalable, sustainable, and accessible to the people in the organization who really need the information. So we need a new measurement framework, one that'll let us understand customer behavior the way it's actually happening, separate product substitution from real cash flows that are new and lost to the bank, and enable us to gain insight into customer behavior. So our new framework should be based on customer behavior because that's what's going to drive balanced growth and attrition. We still want to understand new customer sales and lost customer attrition. That's never going to go away. But we should also be able to understand cross-selling, product attrition, whether customers are borrowing to invest, if they're liquidating to pay down debt, and how much is coming from balanced growth and balanced attrition, as opposed to product substitution where people are moving money from one pocket to another within the bank. The question is, how do these behaviors align up with the traditional performance measurements? So here what we've done is overlay the customer behavior on top of the traditional performance metrics. And it illustrates two problems. One is if you want to understand a customer behavior, you can't get there by looking at any one or combination of those performance metrics. The other problem is that when you're looking at any of those traditional performance metrics, you're in fact getting pieces of multiple customer behaviors. So now we're going to solve this problem by introducing you to the elements of the framework. The first dimension is customer status. Yes, we still care about lost customers, ongoing customers, and new customers. That provides a horizontal slice that lets us see customer acquisition and customer attrition, but everything else is happening within the ongoing customers. Next, we layer on account status and product status. This enables us to do a vertical slice that now gives us the complete picture of the traditional performance metrics. Finally, we add on the third dimension, which is all about the cash flows that are occurring at the individual account level within customer relationships. We identify new money sales, loan to deposit transfers, product substitution flows to product from product, the deposit to loan transfers, and pure lost money attrition. And this new dimension enables us to subdivide those traditional performance metrics into finer and finer grain. When they're all combined, we create a set of cells at the intersection of all of those dimensions. And each of those cells could be described as a combination of customer status, product status, account status, and the cash flow related to the individual customer's account. And when we overlay the behaviors that we were trying to understand on the framework, we can see that each one of the behaviors is now explicitly measurable through the combination of these dimensions. So let's take a look at a practical example, measuring return on marketing investment. Our client, Anne, is charged with growing the retail banking portfolio. She has good analytics, she's got great data scientists, and she's got a host of KPIs, but none of them seem to tie into the numbers that are reported by finance. Her finance people want her to be able to prove return on marketing investment. So let's break it down. We want to understand the sales lift, the impact of product substitution, and the impact on attrition of any given marketing campaign or program. In order to do that, we really need to separate these cash flows and categorize them distinctly, which the framework does. The reason we need to understand this in detail is because product substitution in particular can have positive or negative effects on the return on marketing investment, depending on whether the margins in the target are higher or lower than the margins we were already earning with money that was inside the bank. So we turn to the framework to support the measures. We know we need to be able to measure new money growth. We know we need to measure the inflows from other products and the realized attrition and compare them with control group or historical values. The framework enables us to see the flows between accounts and money that's new to the bank in detail, and we can support all of the metrics that are necessary. And to make it real for you, here are pictures of real business intelligence reports that we've created for customers, where we have historical time series of new money sales, historical time series of lost money attrition, and in any period of time and in time series, we can identify the product substitution events simply by looking at where money came from on rows and where it went to in the columns. So how do you implement this framework? Surprisingly, you only need 6 data fields in order to implement this entire framework. Institution ID, branch ID, product ID, customer ID, account ID, and spot balance. If you can pull that data together, you can have all of this insight into customer behavior and the behavior of your marketing campaigns, your salespeople, and your organization as a whole. If you have a marketing customer information file or a copy of your customer information file that you maintain in time series, you're ready to go. We address security by using 2-key encryption, which is performed inside the bank before any data is sent anywhere. We apply the analysis framework and we send back a reporting package using Microsoft's Power BI platform, which enables our customers to have scalable delivery of reports on the devices of their choice with very flexible business intelligence reporting at an extremely low cost. Because the data requirements are so simple, it doesn't take very long to implement. A trial can be done in as little as 90 days. With a client we've been working with, we backfilled an entire year of data, so you can have time series pretty much from the very beginning, and you can be in production in just a couple of months. If you are interested in being able to manage your sales more effectively, being able to manage your marketing campaigns more effectively, and avoid some of the problems that major institutions have had in gaining an understanding of customer behavior, we invite you to contact us at FlowTracker Analytics and learn more about our patented analytics solution that we can deliver to you as software as a service. Thank you.